Firms take advantage of asset allocation. Asset allocation is the practice of trying to identify how much to put into which asset classes for a particular level of risk and return that an investor might have. You might think of it as how many eggs to put into which baskets. We know we don't want all our eggs in one basket. Asset allocation is trying to decide how much goes where. So in our case, we do things a little differently. We call it active allocation as to differentiate from many investors who use strategic asset allocation. A strategic asset allocation is one where the investments are held in a pretty much a static percentages, whereas our approach is much more engaged, dynamic in terms of what's happening in the world around us. We pay attention to changing circumstances for the economy, whether we're in a recession or a growing, an expanding economy, whether we're seeing rising interest rates or falling interest rates, what's happening for valuations of the investments and so forth. There's a whole variety of things that we're paying attention to, and based on those changing dynamics, we'll make adjustments to the way our allocation is structured, and in that sense, it's active. Now, that's not to say that we just simply will be tactical to the point of we're in the market, we're out of the market. Not at all. We're very much held to an appropriate risk profile for the investor's intentions, but we will make adjustments within that to emphasize where there's opportunity or de-emphasize where there may be risk.
Many advisors use a set and forget it model. A set and forget it model basically takes your strategic asset allocation, as Chris describes, and puts it in some basic mutual funds and doesn't really change the asset allocation ever. We think this is a little weak because it doesn't take advantage of the changing dynamics in capital markets and the economy. A few examples on how our active allocation can take advantages of opportunities and eliminate risks that crop up in the economy include when the equity markets are overvalued, which have happened many times over history. We can underweight stock. If we see an especially good opportunity in growth stocks because interest rates are low, which has happened very much in recent history, we can take advantage of things like that. Other examples might include times when the stock market is dramatically undervalued, and you might want to overweight your asset allocation to take advantage of long-term opportunities. So there's times to be a little bit more fearful, and there's times to be a little bit more greedy in the market within an overall risk assessment. And we think the active allocation does a good job of combining the strategic allocation approach with a more tactical approach that can outperform in the longer term.
Face it, investing can be challenging for anyone under all kinds of circumstances. And we recognize that it can be difficult and challenging and knowing when's the right time to get a second opinion or get some help. But if you find you might benefit from another set of eyes looking at your portfolio and to evaluate if you've got the right mix for your risk temperament, give us a call. We'd be happy to help. You can reach us at 866-771-8901 or through the website amrfinancial.com.